In 2008, I watched the world burn. I had spent years warning anyone who would listen that the housing market was a house of cards, that the mortgage securities everyone owned were worthless, that the entire financial system was built on fraud and delusion. Nobody listened. They called me crazy. They called me a perma-bear. They said I did not understand how the new economy worked. Then Lehman Brothers collapsed. Then Bear Stearns collapsed. Then the stock market lost more than 50% of its value in a matter of months. Trillions of dollars in wealth evaporated. Retirement accounts were decimated. People lost their homes, their jobs, their life savings, and suddenly everyone remembered that I had been right all along. But here's what most people do not understand about 2008. The crash was not just a disaster. It was an opportunity. The greatest buying opportunity of a generation. Stocks that would go on to return 500, 1,000, 2,000% were available for pennies on the dollar. All you had to do was have cash, have courage, and have the ability to see value where others saw only fear. I made money on the crash itself through my short positions. But the real money, the generational wealth, was made by the people who bought at the bottom, who saw companies trading at valuations that made no sense, and had the conviction to act while everyone else was paralyzed by terror. Today, right now, in this market, there are stocks trading at 2008 prices. Not metaphorically, literally. Stocks that have been so beaten down, so abandoned, so hated by the market that they trade at valuations we have not seen since the depths of the financial crisis. And just like in 2008, most investors are too scared to touch them. They see the falling prices and assume something must be fundamentally wrong. They see the negative sentiment and conclude that the smart money must know something they do not. They wait for confirmation, for the stocks to start going up before they buy, which means they miss the bottom entirely. I do not wait for confirmation. I do the analysis. I calculate the intrinsic value, and when the market gives me a price that is absurdly below that value, I buy, regardless of what everyone else is doing. Regardless of how scary the headlines are, regardless of how much further the stock might fall in the short term. Today, I am going to share 4 stocks that are trading at 2008 valuations right now. 4 companies that the market has left for dead, but that I believe will generate enormous returns for patient investors who can see past the fear. But first, let me explain what I mean by 2008 valuations. Because precision matters. In 2008 and early 2009, at the bottom of the financial crisis, stocks across the market traded at extreme valuations, price-to-earnings ratios in single digits, price-to-book ratios below 1, meaning you could buy a company for less than the liquidation value of its assets. Dividend yields of 8, 10, 12% because stock prices had fallen so far that the dividends represented huge percentages of the purchase price. These valuations reflected total despair. Investors assumed that earnings would collapse, that dividends would be cut, that many companies would go bankrupt. They were pricing in the end of capitalism as we knew it. Of course, that is not what happened. The economy recovered, earnings recovered, stock prices recovered, and the people who bought at those extreme valuations made fortunes. When I say a stock is trading at 2008 prices, I mean it has the same characteristics: single-digit price-to-earnings ratio, price-to-book ratio near or below 1, dividend yield that suggests the market expects the dividend to be cut, total abandonment by institutional investors who cannot afford to have these names in their portfolios. These are the stocks I look for, not the popular names that everyone owns, not the growth stocks trading at 50 times earnings. The forgotten, abandoned, hated stocks that trade at valuations reserved for companies on the verge of bankruptcy, even when their fundamentals suggest nothing of the sort. Let me tell you about the first stock. It is in the healthcare sector, specifically the generic pharmaceutical industry. I am not going to name the specific company because my positions are private and naming it would move the market, but I will describe it in enough detail that you can do your own research. This company manufactures generic drugs. It has been around for decades. It has a portfolio of hundreds of products that treat everything from infections to chronic diseases to pain. These are essential medications that people need regardless of what the economy is doing. The stock has been crushed over the past several years for several reasons. Pricing pressure from pharmacy benefit managers and insurers who demand ever lower prices. regulatory scrutiny over pricing practices, a few manufacturing quality issues that required remediation, debt taken on to fund acquisitions that have not worked out as planned. All of these concerns are real. I am not dismissing them, but they are already reflected in the stock price, and then some. The stock trades at less than 4 times earnings. 4 times. That means if the company's earnings stayed flat forever, you would get your money back in 4 years, and everything after that would be profit. But earnings are not going to stay flat forever. The generic drug industry has structural advantages that will persist. As the population ages, demand for medications increases. As branded drugs lose patent protection, generics capture market share. The volume growth in this industry is essentially guaranteed by demographics. The company has been paying down debt aggressively. The balance sheet that worried investors 2 years ago looks much healthier today. Interest coverage ratios have improved. Maturities have been extended. The bankruptcy risk that the market seems to be pricing in is simply not supported by the financial statements. The dividend yield is over 5%. That dividend has been maintained through the worst of the company's troubles. Management has committed to maintaining it going forward. At a 5% yield with a 4 times earnings multiple, you are being paid handsomely to wait for the market to recognize the value that is already there. I started buying this stock when it was higher than it is today. I added as it fell. I am still adding, because the lower it goes, the more attractive it becomes. The margin of safety widens with every decline. This is classic value investing. Buying $1 for 50 cents. Buying a business that generates real cash flows at a price that assumes those cash flows will evaporate. Being greedy when others are fearful. The second stock is in the financial sector, specifically regional banking. Again, I will not name the specific institution, but I will describe the characteristics that make it attractive. Regional banks have been annihilated since the Silicon Valley Bank collapse in early 2023. The entire sector sold off as investors panicked about deposit flight, unrealized losses on bond portfolios, and the potential for a cascading banking crisis. Most of that panic was overdone. Yes, some banks had problems. Yes, a few failed, but the regional banking system as a whole remained sound. The FDIC stepped in. The Federal Reserve provided liquidity facilities. The contagion that everyone feared did not materialize. And yet, regional bank stocks remain at levels not seen since 2008, price-to-book ratios below 1, meaning you can buy the banks for less than the value of their assets minus their liabilities. Price-to-earnings ratios in the mid-single digits. Dividend yields of 4, 5, 6%. The specific bank I own has a conservative lending culture that has served it well through multiple credit cycles. Its loan portfolio is primarily commercial real estate and small business lending in markets it has operated in for decades. Management knows these markets, knows these borrowers, and has underwritten conservatively. Yes, commercial real estate is a concern. Office buildings are struggling with remote work. Some loans will go bad. But this bank's exposure is primarily to multifamily, industrial, and retail properties in growing markets, not to office towers in struggling downtowns. The credit quality concerns are real, but overstated for this particular institution. The bank has excess capital, more than regulators require, and more than peers hold. This capital cushion provides protection against loan losses and also positions the bank to take advantage of opportunities. When weaker banks fail or need to sell assets, well-capitalized banks can acquire those assets at attractive prices. The deposit base is stable. Unlike Silicon Valley Bank, which had concentrated deposits from venture-backed startups, this bank has a diversified deposit base from retail customers and small businesses. These depositors are sticky. They have multiple relationships with the bank. They are not going to flee at the first sign of trouble. At current valuations, I am buying this bank for less than the cash and securities on its balance sheet, getting the entire loan portfolio essentially for free. That is 2008 pricing. That is the kind of opportunity that appears once every decade or two. The third stock is in the energy sector, specifically an offshore drilling company. This is perhaps the most contrarian position I hold, and it requires some explanation. Offshore drilling has been a terrible industry for a decade. The shale revolution made onshore drilling in the United States so economically attractive that offshore projects could not compete. Oil prices crashed in 2014, and again in 2020. Drilling companies went bankrupt in waves. Rigs were scrapped or cold stacked. The entire sector was left for dead. But something interesting has happened over the past few years. Offshore drilling has started to recover, not because oil prices spiked, although they did for a while, but because the fundamentals of supply and demand have shifted. Onshore shale drilling has matured. The best acreage has been drilled. Productivity gains have slowed. The growth rates that made shale so attractive are no longer achievable. Meanwhile, global oil demand keeps growing. Someone has to supply that demand, and increasingly, that someone is offshore. The offshore drilling companies that survived the downturn have emerged leaner and more disciplined. They scrapped their oldest, least efficient rigs. They paid down debt. They negotiated better contracts with oil companies who need their services. Day rates, the daily fee that drillers charge to operate a rig, have been rising steadily. Utilization rates have been rising. Contract backlogs have been building. The industry is in the early stages of a cyclical recovery that could last for years. And yet, the stocks trade at valuations that assume the downturn is permanent. Price-to-earnings ratios in single digits. Enterprise values below replacement cost, meaning it would cost more to build a new rig than to buy an existing company with rigs already operating. The specific company I own has a modern fleet of high-specification rigs that are in demand for the most technically challenging offshore projects. These are not commodity assets, they are specialized equipment that oil companies need for deepwater drilling and cannot easily replace. The balance sheet has been repaired. Debt that seemed insurmountable a few years ago has been paid down or restructured. The company generates positive free cash flow at current day rates, and day rates are rising. This is a cyclical investment, which means timing matters more than with other value stocks. I believe we are in the early innings of an upcycle. The supply of rigs has been rationalized. Demand is growing. Pricing power is returning. These are the conditions that produce multi-bagger returns in offshore drilling stocks. The risk is that oil prices collapse and take day rates with them. I am willing to accept that risk because I believe the structural underinvestment in oil supply makes sustained low prices unlikely. But this is a position that requires monitoring. It is not a buy and forget investment. The fourth stock is in the retail sector, specifically a brick-and-mortar retailer that has been left for dead in the age of e-commerce. This might seem like an insane investment. Everyone knows that Amazon has destroyed traditional retail. Everyone knows that malls are dying. Everyone knows that physical stores are dinosaurs waiting for the asteroid to finish them off. Everyone is wrong. At least about this particular retailer. The company I own has something that Amazon cannot replicate: a physical presence in communities across America where customers can see, touch, and try products before buying. A service model that creates relationships with customers who come back year after year. A product category where tactile experience matters and online shopping is a poor substitute. I am being deliberately vague because I do not want to reveal my position, but think about categories where you would never buy online without first experiencing the product in person. Where expert advice from knowledgeable salespeople creates value that cannot be replaced by an algorithm. Where the purchase decision is infrequent and consequential enough that customers want human guidance. This retailer has been adapting to the new environment. They have invested in their online presence while maintaining their physical stores. They have cut costs and improved efficiency. They have used their stores as distribution centers for online orders, turning what seemed like a liability into an advantage. The stock trades at 5 times earnings. 5 times. The company generates consistent free cash flow. It pays a dividend yielding over 4%. It has been buying back shares at these depressed prices, which I view as intelligent capital allocation when a company's stock is this cheap. The market assumes this company is going to zero. That assumption is reflected in the stock price. But the financial results suggest otherwise. Revenue has stabilized, margins have held up. The business is not thriving, but it is not dying either. It is muddling through, generating cash, and rewarding shareholders. At 5 times earnings, I do not need this company to thrive. I just need it to survive. If it merely maintains current profitability, I will earn a 20% annual return on my investment. If it manages to grow even modestly, the returns will be much higher. And if the market ever recognizes that the company is not actually dying, the multiple expansion alone could double or triple the stock price. This is what 2008 valuations look like. Total despair priced into the stock, even when the fundamentals do not justify total despair. The assumption that the worst case is the base case, when in reality the worst case is already more than priced in. Let me talk about what these 4 stocks have in common, because the pattern matters more than the specific names. All 4 are deeply out of favor. Institutional investors have abandoned them. Analysts have stopped covering them or issue only sell ratings. They do not appear on any hot stock list or momentum screen. They are the stocks that investment committees refuse to discuss because nobody wants to be associated with losers. All 4 trade at valuations that assume permanent impairment, not temporary difficulty, but permanent destruction of value. The market is pricing these stocks as if they will never recover, as if the bad times will last forever, as if mean reversion is no longer a thing. All 4 have real businesses generating real cash flows. These are not speculative companies with no revenue. They are established businesses with decades of history, with assets, with customers, with products that people need. The businesses have problems, yes, but problems can be solved. Businesses can be turned around. What cannot be fixed is a company with no underlying value, and these companies have underlying value. All 4 have catalysts that could unlock that value. In the generic drug company, it is debt paydown and stabilizing pricing. In the regional bank, it is credit quality proving better than feared and capital returns accelerating. In the offshore driller, it is the cyclical upturn in day rates. In the retailer, it is simply not dying as everyone expects. When I build a portfolio of stocks like these, I am not betting on any single name. I expect some to work and some to disappoint. Value investing does not have a 100% hit rate, but across a portfolio of deeply undervalued stocks, the math works in your favor. The winners more than compensate for the losers because you are buying at such low valuations that the upside dramatically exceeds the downside. Let me talk about risk management, because this is where most value investors fail. Buying cheap stocks is not enough. You have to buy cheap stocks that survive. A stock trading at 2 times earnings is not a bargain if the company goes bankrupt and the equity is wiped out. The cheapness is a trap if it reflects genuine distress rather than temporary pessimism. This is why balance sheet analysis is so critical. I spend more time studying balance sheets than income statements. I want to know how much debt a company has, when it matures, what covenants constrain management, how much liquidity is available. A company with a strong balance sheet can survive almost any operational difficulty. A company with a weak balance sheet can fail even if operations are sound. All 4 of the stocks I described have balance sheets that can withstand stress. They have liquidity. They have manageable debt maturities. They are not going to be forced into bankruptcy by a temporary downturn. This is non-negotiable for me. I do not buy deeply distressed companies that might not survive because the equity upside is not worth the bankruptcy risk. Position sizing also matters. These are not positions where I put 50% of my portfolio. They are 5% positions, maybe 10% for the highest conviction ideas. Diversification across multiple value stocks reduces the impact of any single name blowing up. And I have a sell discipline. I do not hold forever just because a stock is cheap. If the thesis breaks, if the fundamentals deteriorate beyond what I underwrote, I sell regardless of the loss. The goal is not to be right about every position. The goal is to make money across the portfolio, which requires cutting losers before they become catastrophic. Let me address the psychological challenge of buying stocks like these. It is genuinely difficult. Every instinct tells you not to do it. When you buy a stock that is down 80%, you feel stupid. The market is telling you this is a bad company. Analysts are telling you this is a bad company. Your friends and family, if you are foolish enough to discuss your investments with them, will tell you this is a bad company. The price action screams that you are wrong. You have to have conviction that comes from your own analysis, not from external validation. You have to trust your work, even when the market is telling you the work is wrong. You have to be comfortable being alone in your positions, sometimes for years, before they work out. This is not for everyone. Most people cannot do it. They need the comfort of consensus. They need the validation of rising prices. They need to see momentum before they buy. That is fine. Those people can earn market returns by owning index funds. There is no shame in that. but they should not try to be value investors because they do not have the temperament for it. For those who do have the temperament, the rewards can be extraordinary. Buying at 2008 valuations and holding through the recovery can generate returns that transform financial situations. The opportunity is there. The question is whether you can stomach the discomfort of seizing it. I want to share something about how I think about time horizons, because it is relevant to these positions. I do not know when these stocks will recover. It could be next quarter, it could be next year, it could be 3 years from now. The market does not operate on my schedule. It reprices assets when it is ready, not when I want it to. This means I need to be patient. I need to be willing to hold positions that go nowhere or even decline further before they eventually work. I need to ignore the short-term noise and focus on the long-term value. But I also need to be realistic. If a position has not worked after several years, if the thesis has not played out, I need to reassess. Maybe I was wrong about the value. Maybe the market is right and I am wrong. The passage of time without validation is information. It should not be ignored. My typical holding period for a value position is 2 to 4 years. That is long enough for the market to recognize value, but short enough to admit when I am wrong. If a stock has not re-rated after 4 years, something is probably wrong with my analysis. For the 4 stocks I have described, I believe the catalyst will play out within that time frame. The generic drug company will demonstrate stable earnings and debt reduction. The regional bank will prove its credit quality is sound. The offshore driller will benefit from the cyclical upturn. The retailer will survive, and the market will stop pricing in death. If I am right, the returns will be substantial. If I am wrong, the downside is limited by the already depressed valuations. This asymmetry is what makes value investing attractive. You risk 1 to make 3 or 4 or 5. The math works over time, even if individual positions disappoint. Let me close with some broader thoughts about this market environment and why opportunities like these exist. We are in an unusual market where a small number of large technology stocks have dominated returns. The Magnificent Seven, or whatever people are calling them now, have driven the indices higher while the rest of the market has languished. This concentration has created a two-tier market. A small number of stocks trading at high valuations and commanding all the attention, and a large number of stocks trading at low valuations and being completely ignored. This divergence cannot last forever. Either the high flyers will correct or the laggards will catch up. Mean reversion is one of the most powerful forces in financial markets. It operates slowly, sometimes taking years to play out, but it operates reliably. When the rotation happens, when investors tire of paying 50 times earnings for growth stocks and start looking for value, the stocks I have described will benefit enormously. The money that has been concentrated in a handful of names will spread out across the market. The abandoned sectors will be rediscovered. I do not know when this rotation will happen. I am not trying to time it. I am simply positioning for it. By owning deeply undervalued stocks across multiple sectors, I will benefit when the rotation comes, regardless of exactly when or how it happens. This is the essence of value investing. You do not predict. You do not time. You identify value and you position for it. You let the market come to you rather than chasing the market. 4 stocks trading at 2008 prices. A generic drug company at 4 times earnings. A regional bank below book value. An offshore driller at replacement cost. A retailer at 5 times earnings with a 4% yield. These are the opportunities that exist in this market if you are willing to look where others are not looking. If you are willing to buy what others are selling. If you are willing to be uncomfortable in the short term to generate extraordinary returns over the long term. The market is giving you a gift. The question is whether you have the courage to accept it. I have done my analysis. I have calculated my values. I have made my bets. Now I wait for the market to recognize what I already know. That these stocks are worth multiples of their current prices. That 2008 valuations create 2008 opportunities. That fear creates the best buying opportunities for those who can overcome it. The next few years will tell whether I am right. I believe I am. But even if some of these positions disappoint, the portfolio will work. The math ensures it. Buy enough deeply undervalued stocks, and the winners will overwhelm the losers. That is how I invest. That is how I have always invested. And these 4 stocks are where I am putting that philosophy into practice right now. But let me go deeper on each of these positions, because I think the details matter. Understanding why these stocks are cheap is just as important as understanding that they are cheap. The market is not stupid. When something trades at 4 or 5 times earnings, there is usually a reason. The question is whether that reason justifies the valuation or whether the market has overreacted. Let me elaborate on the generic pharmaceutical company. The generic drug industry has been through a brutal period. For years, generic companies operated in a relatively benign environment. They would wait for branded drugs to lose patent protection, file abbreviated applications with the FDA, and launch generic versions at prices significantly below the branded product. The margins were healthy. The growth was steady. The business model worked. Then several things changed simultaneously. Pharmacy benefit managers, the middlemen who negotiate drug prices on behalf of insurers and employers, gained power and started demanding lower prices. Wholesalers consolidated and gained negotiating leverage. The FDA accelerated generic approvals, increasing competition, and prosecutors started investigating pricing practices, creating legal liability. The result was a collapse in profitability across the industry. Companies that had been earning fat margins found those margins compressed. Stock prices followed earnings lower. Some companies went bankrupt. Others were acquired at distressed prices. The survivors struggled to adapt to the new reality. The company I own has survived this transition. It has cut costs aggressively. It has exited low-margin products and focused on specialty generics, where competition is less intense. It has invested in complex dosage forms and delivery systems that are harder to replicate. It has been managing through the transition rather than denying it. What the market is missing is that the transition is largely complete. The industry has been rationalized. Weak players have exited. Pricing has stabilized at levels that are sustainable for efficient operators. The worst is over. But the stock is still priced as if the worst is ongoing, as if prices will continue falling indefinitely, as if the company will eventually go bankrupt. That disconnect between reality and perception is the opportunity. The pharmaceutical industry also has a demographic tailwind that is underappreciated. The baby boom generation is aging into their peak years of medication consumption. People over 65 take an average of 4 to 5 prescription drugs per day. As this enormous cohort ages, demand for generic medications will grow regardless of pricing pressure on individual products. I have modeled out the company's cash flows under various scenarios. Even in a pessimistic scenario where pricing continues to erode, the company generates enough cash to service its debt and maintain its dividend. In a base case scenario where pricing stabilizes, the stock is worth 2 to 3 times its current price. In an optimistic scenario where the company gains market share and margins expand, it is worth 5 times current levels. The risk-reward is asymmetric. Limited downside because so much pessimism is already priced in. Substantial upside if reality proves better than expectations. This is the setup I look for. Now let me expand on the regional bank thesis because I think people fundamentally misunderstand the banking business. Banks make money by borrowing short and lending long. They take deposits, which are essentially short-term loans from customers, and make loans, which are long-term commitments to borrowers. The spread between what they pay for deposits and what they earn on loans is their profit. This sounds simple, but the execution is complex. Banks have to manage credit risk, the possibility that borrowers will not repay. They have to manage interest rate risk, the possibility that rates will move against them. They have to manage liquidity risk, the possibility that depositors will demand their money faster than the bank can generate cash. Silicon Valley Bank failed because it mismanaged all 3 risks simultaneously. It had concentrated credit exposure to a single industry. It had massive interest rate risk from a bond portfolio purchased at low yields. And it had concentrated deposits from a customer base that was prone to coordinated withdrawal. The bank I own is the opposite of Silicon Valley Bank on every dimension. Credit exposure is diversified across industries and geographies. Interest rate risk is hedged through asset liability management. Deposits are granular and sticky, spread across thousands of small accounts rather than concentrated in a few large ones. This bank has operated through multiple credit cycles without significant losses. Management is conservative and experienced. They have seen downturns before and have built reserves accordingly. The underwriting standards have not slipped despite competitive pressure to make riskier loans. The commercial real estate exposure, which is what everyone worries about, is concentrated in property types that are performing well, multifamily buildings in growing markets where rents are rising, industrial properties benefiting from e-commerce growth, retail properties in necessity-based categories like grocery and healthcare. The office exposure that scares everyone is minimal. I have gone through the loan book in detail. I have stress-tested the portfolio under various economic scenarios. Even in a severe recession with significant job losses and property value declines, the bank has enough capital to absorb losses and continue operating. The bankruptcy risk that the market seems to be pricing in is simply not supported by the numbers. At current prices, I am buying this bank at a 40% discount to tangible book value. That means even if the bank earns nothing and just liquidates over time, I will make money. Any positive earnings are gravy. Any return to normal valuations generates enormous returns. The offshore drilling company deserves more elaboration because this is a sector that most investors have written off entirely. The offshore drilling industry nearly died in the 2010s. When oil prices crashed in 2014, the economics of deepwater drilling became unworkable. Day rates that had been $500,000 per day fell to $150,000 per day. Utilization that had been 90% fell to 50%. Companies that had taken on debt to build new rigs found themselves unable to service that debt. The resulting carnage was brutal. Almost every major offshore driller went through bankruptcy. Some liquidated entirely, others restructured, wiping out equity holders and converting debt to equity. Rigs were scrapped because they were worth more as steel than as drilling equipment. But the industry that emerged from this process is fundamentally healthier. The excess rigs have been eliminated. The remaining companies have clean balance sheets. The management teams are focused on returns rather than growth. The discipline that was lacking during the boom has been imposed by near-death experience. And the supply-demand balance has shifted. Global oil demand continues to grow. Shale production growth has slowed. OPEC discipline has tightened. The world needs more oil. And increasingly that oil has to come from offshore because that is where the remaining reserves are. The major oil companies have announced billions of dollars of new offshore projects. Brazil, Guyana, West Africa, the Gulf of Mexico, there are sanctioned projects that will require drilling for years. The backlog of contracted work for offshore drillers has grown to levels not seen since before the downturn. Day rates are responding. High-specification deepwater rigs that were earning $200,000 per day 2 years ago are now commanding $400,000 per day. And rates are still rising as available capacity tightens. The company I own has a fleet that is ideally positioned for this market. Modern drill ships capable of operating in the most challenging deepwater environments. Rigs that oil companies specifically request because they have track records of safe, efficient operation, equipment that would cost billions of dollars to replicate and cannot be built quickly. At current stock prices, I am paying less than the replacement cost of the fleet. I am getting decades of remaining asset life for less than it would cost to build new. That is a valuation that makes no sense, unless you believe the industry is permanently impaired, and I do not believe that. The retailer requires the most explanation because the bear case seems so obvious. Everyone knows retail is dying. Everyone knows Amazon is taking over. Everyone knows brick-and-mortar stores are dinosaurs. Everyone is mostly right, but not entirely right. The disruption of retail is real but uneven. Some categories have been devastated. Books, electronics, commodity goods that can be easily shipped and compared online. Other categories have proven more resilient. Experiences that require physical presence, products that require expert advice, purchases where tactile evaluation matters. The retailer I own operates in a resilient category. I am not going to be more specific because I do not want to reveal my position. But think about what you would never buy online without first experiencing it physically. Think about purchases where you value expert guidance. Think about products where the wrong choice has significant consequences. This retailer has invested heavily in the customer experience. Their salespeople are trained extensively. Their stores are designed to facilitate product evaluation. Their service after the sale creates loyalty that Amazon cannot match. Yes, the company has lost market share to online competitors. Yes, revenue has declined from peak levels. Yes, the business is smaller than it used to be. but it has stabilized at a level that generates consistent profits. The decline has slowed to the point where it might be ending. Management has adapted intelligently. They have closed underperforming stores and invested in the best ones. They have built an e-commerce presence that complements rather than cannibalizes physical retail. They have cut costs and improved efficiency. They are running a tighter operation than they were 5 years ago. The balance sheet is solid. The company has minimal debt and generates enough cash to fund operations without external financing. The dividend has been maintained through the difficult years. Share buybacks have reduced the share count, increasing the value of remaining shares. At 5 times earnings with a 4% dividend yield, the stock is priced for permanent decline. But if decline merely slows, the stock is undervalued. If the company stabilizes, it is dramatically undervalued. If it somehow manages to grow, the returns will be extraordinary. I do not need this company to become Amazon. I just need it to not die. At current valuations, survival is the only catalyst required for significant returns. Let me address a question I often get about value investing. If these stocks are so cheap, why are not more people buying them? Why has not the market corrected the mispricing? The answer has to do with how institutional investing works. Most professional investors are evaluated on short-term performance. They cannot afford to buy a stock that might go down for 2 years before it goes up. Their clients will fire them. Their bosses will fire them. The incentives are all wrong for patient investing. Additionally, institutional investors face pressure to own popular stocks. If you own Apple and it goes down, you were wrong along with everyone else. That is forgivable. If you own some obscure generic drug company and it goes down, you were wrong when everyone else was right. That is career ending. This creates a dynamic where cheap stocks stay cheap because the people who should be buying them are institutionally prevented from doing so. The mispricing persists because the marginal investor is focused on career risk rather than investment risk. Individual investors have an advantage here. You do not answer to clients. You do not have to justify your positions to an investment committee. You can buy something that is unpopular and hold it until it works without worrying about being fired. This advantage is real, and you should use it. The market will eventually recognize value. It always does. But it does so on its own schedule, not yours. The professional investors who cannot wait will miss the opportunity. The patient investors who can wait will capture it. 4 stocks. 2008 valuations. Opportunities that appear once every decade or two. The market is giving you a chance to buy quality businesses at distressed prices. Whether you take that chance is up to you. I have done my work. I have made my bets. Now I wait for the market to catch up to reality. History suggests it will. The returns for those who saw the opportunity and acted will be substantial. The regret for those who saw the opportunity and hesitated will be real. Choose wisely, act decisively, and be patient. That is how value investing works. That is how 2008 opportunities become 2018 returns. That is how fortunes are made while others watch from the sidelines.